Yeah, welcome to my channel. Uh, we are going to simplify accounting. So we are introducing accounting one or fundamental principles of accounting. Yeah, so we are going to start with easy things. We shall start with the elements of financial statements. We look at what we debit and then what we credit. Yeah, so we shall be handling each and everything, calculations only. Yeah. So we are going to start with the elements, elements of financial statements. Elements of financial statements. They are they are five. The formula is Alice, whereby A is for assets. Assets are divided into two. We have the non-current assets, also known as fixed assets. Then we have the current assets. Non-current assets, these are assets that stay in the business for a period longer than 1 year. Yeah, it's where we have things like buildings, land, furniture, machines, all that. Then the current assets, they stay in a business for a period less than 1 year. It's where we have things like inventory, trade receivables, prepaid expenses, stuff like that. Then liabilities, L is for liabilities. Liabilities, it is an obligation to the entity, something like a debt. So liabilities will also have non-current or long-term, then current or short-term. So non-current or long-term, they stay in a business. It is an obligation to the business for a period exceeding 1 year. If a business has a debt that goes beyond 1 year, it becomes a non-current liability. And an example of that is usually a loan. If I tell you that the business has, let me say, a 5-year loan, a 2-year loan, it becomes a non-current liability. But if they tell you that a business has a 6 months loan, it becomes a current liability. Current liability is an obligation to the business, but for a period less than 1 year. It's where we have things like trade payables, things like accrued expenses. I is for income, income to the business, like revenue. Then C is for capital. Under capital, we have things like equity, retained earnings, share premium, then capital reserve. Then E is for expenses. Yeah, expenses are many. We have salaries and wages, we have depreciation, we have electricity, we have rent, transport, discount allowed, all that. Yeah, so These are the 5 elements of financial statements. Yeah, in case they ask about them, these are the ones. You just have to cram this formula, Alice. Assets, liabilities, income, capital, and then expenses. Yes, so now let's look at their effects on the debit side and then on the credit side. So let's look at their effects on debit and then on the credit side. Their effect on the debit and credit side. So we have our elements here, the 5. So we start with assets. So when assets are increasing, we debit. Assets increase by debiting. So if you have things like let me say if receivables are increasing, you debit the receivables account. If you buy a new asset, maybe you buy let me see, you buy a motor vehicle, so you'll have to debit the motor vehicle account. So assets increase by debiting, and in case you sell a motor vehicle, you will have to credit the motor vehicle account. So assets increase, they increase or plus by debiting. Then they reduce or negative by crediting. That is it. If an asset is increasing, you debit. If it's reducing, you credit. Then liabilities. Liabilities, these are debts. Now it's the opposite of assets. When the liability is increasing, you credit. When it's reducing, you debit. Yeah, let me give an example of creditors or the trade payables. If you get more goods on credit, you will have to credit the trade payables account because liabilities are increasing. Then if you pay some of the creditors or the people that are demanding you, you will have to debit the trade payables account. So liabilities increase by crediting and they reduce by debiting. So on the debit side, it will reduce. Yeah. Then here it will increase, which is a plus. So liabilities increase by crediting and they reduce by debiting. So whenever you see a liability increasing, just know you're supposed to credit it. If you see it reducing, you debit it. Then income. Income, it also has the same treatment like liabilities. They increase by crediting. Then they reduce by debiting. Then capital, same treatment. Increase by crediting. If the business maybe acquires more capital, you credit the capital account. If it's then it reduces by debiting. Then for expenses have the same treatment like assets. So what you're supposed to cram here is that the first and the last have the same treatment, and then these in the middle also have the same treatment. So expenses increase by debiting, then they reduce by crediting. Yeah. So if electricity is paid, you debit the electricity account. If it's not paid, you credit. Yeah. And then about then the opening balance. Opening balance is also known as the normal balance. Normal balance. So in the case of assets and expenses, they have a normal debit balance. So balance brought down is always on the debit side. Even here, balance brought down is on the debit side. The opening balance is always on the increasing side. You get normal, normal debit balance, normal debit balance. Then for these three in the middle, they have a normal credit balance. Like the balance brought down will be on the credit. Balance brought down, balance brought down will be on the credit side. That is the brief introduction. Hope it has been helpful, but we shall be getting to know more as we continue. So thanks for watching. Do not forget to subscribe, like, comment, share with your friends. Let's catch up in my next video.